Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts, like the chart behind me, which is of Unity Software, ticker symbol U. And so I wanted to go over some of the unusual whales data here, and I thought I'd just make a video on it. So hopefully this is enjoyable for you guys. Let me know in the comments below if you do like it. Give it a thumbs up if you do enjoy. But yeah, first really just going to look at the chart, and then I will get into that unusual whales data. But here we can see that Unity closed last week on Friday. Was that July 11th at a price of $28.93, actually being down on the day by 0.79%, as you can see over here. It does look like, it might be getting rejected from right around the $30 area. So maybe we're going to see a pullback. I do have some lines drawn here, haven't put them up here recently, and we can just take a step back to see what those lines correspond with. So we do have, this orange uptrend that does look like it is based on, let's see, the pivot points being the low from August of 2024, and then over here, the low from November. And did act as support here before breaking lower, then acted as resistance, breaking above, and then kind of hanging out below before the recent moves that we saw. So maybe we could be pulling back to that. Maybe, though, that would also correspond with this red downtrending line, which you can see has, a pivot point approximately the high over here from February 21st of this year, and then also kind of the highs over here from, looks like the beginning of June. Then we can go back a little bit further and we can see more pivot points from that red downtrend going back to the highs of 2023 and going back even further. This is the high in August of 2022. So that has been a pretty notable level of resistance, and we are now above it. So I could most definitely see Unity Software pulling back to that trend line. But, is that trend line going to be revisited over here where the cursor is? That would be at a price of around $27, or maybe a little bit further down, like at this intersection, and that would be around $26, or, even could be breaking below that orange uptrend again, and, coming back maybe to the mid-20s to retest that red downtrend as support. So other ways that we could get an idea of where this could be pulling back to is by doing a Fibonacci retracement. And so I haven't done this yet, so I'm just going to do it from the low here that was hit on June 23rd and then go up to the high from Friday. Well, actually, this is, Friday. It says July 9th. What's going on? This date can't be right. It says, I don't know if you can see it on your screen, but it says July 9th. But if Sunday's the 13th, that would be actually the 11th. So I am not sure what's going on with this. And maybe I should actually check my phone to see what price Unity did close at and if the chart looks the same. Because this looks a little bit wonky. I mean, it's not a 3-day weekend. No, I was at work Friday and I was unhappy about it. But yeah, 28.93. And yeah, this chart does not look like it's complete. So what I'm going to do is I'm going to quit Webull and I'm going to reopen that. And so hopefully that clears out the issues. Yes, so okay. My analysis of Unity, take it with a grain of salt because that was actually from Wednesday the 9th. It did roll over. And so, not really too surprising to see that. But now I'm wondering, is this creating a bull flag? Is this going to be going higher? Or, is this going to be retracing to any of those trend lines that I had just gone over? And so we can do a Fibonacci retracement going from that low from June 23rd. Sorry about the mix up there. And so just doing that retracement from there up to this high, we can see that the 382 is around 27. 27.10, and I don't want to do that now. And 50% is around 26. So those are two levels, and that also does the 50% corresponds with the intersection here. So I view those as two levels that we could be pulling back to, and I am going to remove the 618 and the 786 just because, we first got to get to these levels and then maybe reassess down there. Other things to consider about these two levels that I have up here, the 50% around 26.16, that retracement does correspond with the tops over here, really like the consolidation highs over here where we had wicks going above. But, just like you're never going to be able to sell the exact top, there were multiple opportunities to trim, multiple days that, consolidation highs. And that would be right around. We could just actually look at the open price from June 4th. That is at 26.50. So right around there, I could see us coming back to between 27 and 26. So that makes sense, finding some support there before maybe continuing higher. So that's kind of my perspective on Unity as far as just looking at the stock goes. Do think we got a rejection from right around 30. I do think it will be pulling back some, but I think it's going to be a healthy pullback. I do think that it's going to be going higher. And I must say that I do hold some shares. I do hold some calls, and I was trimming the calls last week, really throughout the week, just trying to manage risk. I could have sold some higher. I could have, bought back more on the dips, but I didn't buy back. I was just trimming. But I do think that it could be coming down some more. And so I think that could be a nice opportunity to add, whether that's shares or whether that is call contracts. But options are very risky, so you got to do that, manage your own risk. I might adjust some of these filters here, not filters, the alerts. So I do have one that's above 30. We did hit that, hitting the high last week at $30.14. So I think that's a good one. I am going to leave it there. And then, $22, $20, $20.75. I don't think those are happening. So what I might want to do is adjust these to be below 27 and then be below 26. Maybe I just might as well just do it, based on the exact levels from those Fibonacci retracements. So 27.10 and then 26.16. And then I'm going to delete this other one because I don't think that's happening. So those alerts are marked there. As you can see, the little alert bell corresponding with that Fibonacci retracement. And so we will have to see if we do get that pullback. Although having closed the week almost above 29, right around $29, if we do look over at the max pain for the week, so for the week that ended on July 11th, max pain was $26. So we did not close at the money. We closed in the money, multiple strikes above $26. And I believe for these contracts, they are in 50-cent increments. So if we closed on Friday at $28.93, closing at 26, that would have been fine at max pain. But we closed, let's see, 26.50, 27, 27.50, 28, 28.50. We closed 5 strikes above the max pain. So 26.50, 27, 27.50, 28.20. Yep, 5 strikes above. So I think that's really good. I wonder if that could be triggering a gamma ramp or a gamma squeeze with the price going a lot higher. We do, though, have max pain for this coming Friday, I should say, on the 18th, July 18th, at $25. So good to be cautious of that. Maybe that acts as a magnet to pull the price down. But if we are closing above max pain again for this week, even the following week after that, really all of these strikes that are on this, the next time that the max pain corresponds with being at the money, current price around $29, is a max pain of $29 for August 29th. So we've got multiple months of max pains, multiple strikes below current price. Even this one that's pretty high at 27, we are multiple strikes above that. So I think that this is looking really good from an option standpoint, or at least from a Max Payne standpoint, that things could be continuing to move higher because we are so many strikes above Max Payne. So I really like that a lot. But then I did want to go over some of these contracts. A lot of them did expire on Friday. And so that's kind of why I wanted to make a video of my process going through this, because I'm not going to be looking at these contracts anymore, and just to kind of evaluate them to see what's happened. One of these contracts that's up here, I do hold, and I will share that with you as I get to it. But for the most part, I am really just looking at this Unusual Whales options data to use as a tool for understanding whether or not a top is in, or if it's going to continue higher or maybe start to pull back. And so we've got a number of these contracts that did expire on July 11th, so on Friday. And I have to give a shout out to a couple people. I'm just going to pull it up over here. One of them is the Bronx Viking. He posts about Unity software a lot. He's got this one here pinned from July 8th saying, still early. And he posts a lot of great stuff on Unity, and he also posts a lot of really nice screenshots from Unusual Whales that I am able to kind of follow along, and they've really helped my learning process with Unusual Whales. So just giving a shout out to him. I think he's a really great, very straightforward communicator with the stocks, with the options flow, and so I would encourage following him. And then another person is going to be Orlando, very similar. I think that maybe I don't know. I mean, like, everybody's different. Everybody has different styles. It's like, is one better than the other? Does one work better with me? I mean, I think they're both valuable, very valuable perspectives, both of them. I do think that the Bronx Vikings very simple, very easy to understand. And Orlando, let's see, he does post about Unity software a lot. He is a long-term bull, though, so maybe that's kind of a caveat that he sees the long-term trajectory of Unity and is not necessarily as dialed into the shorter-term stuff. He's just happy going long for the long term, but he also does a lot of great options, flow, posting, and stuff as well. So two people that I would encourage following, and they are actually the reasons why I was able to identify some of these contracts, either based on their screenshots or, having learned from their screenshots, I was able to find some of these independently. So, so we're just going to dive into those. And so the first one here that I have highlighted, I'm just going to work my way up the list here, and that is going to be the $25.50 call that did expire a couple days ago. And so what we could see is we did see some selling here of those contracts. We're not going to be able to get the data for what was opened or closed on Friday, although we can see it up here, but not just like in the table like this, because this is expired now. But anyways, what we can see is for this contract, the data up here, about $30,000 was traded on it, on Friday. But all of these contracts, closed in the money. So maybe some of them will get exercised, and if they do get exercised, that means market makers need to supply 100 shares per contract that's exercised, and whoever exercises them would be getting the shares at an average price, at a price of $25.50. So that's lower than current price. So if you are a bull with Unity, it would make sense to maybe exercise some of those calls. So maybe that could be leading to a gamma ramp or something like that. But then we're just going to look back over the past 7 days, because I think this is the reason why this contract stood out to me was we can see on July 3rd, so Thursday from a couple weeks ago, which was effectively the last day, or this effectively the Friday, the last day of the week because of July 4th, we saw a candle premium of just shy of $500,000 with a daily premium of over $500,000. And it looks like this was on July 3rd. So if I do scroll down here, we can see that data. It looks like that was, actually, this is July 3rd. it seems like, yeah, okay, so the volume was 3,000. Maybe I actually want to go back a little bit more than 7 days, so 14 days. Yep, so what we've got here is this is on July 1st. It looks like we had a volume of over 3,000 contracts. Then we saw an increase on the 2nd of 3,000 contracts. And then on the 3rd, we saw a volume of over 3,700, and then a decrease of about 900 contracts. So all of those, not all of those were closed. Some of them were. And yep, we do see that the open interest remained above 2,000 into expiration. So yeah, I mean, these are in the money strikes, in the money calls. And so I think that, looks really good for Unity to continue higher. I'm just going to switch this back over to the 1 day and look at the next one on the list, which is the $26.50 call, which also expired on Friday. And so we can see that open interest for this one remained over 6,000. The volume was 180 on Friday, so not all of those 6,000. So a lot of them were expiring in the money. Maybe some of them were exercised. That could again be pushing the stock price higher because this strike is in the money. And then we do look at the past 14 days. We can see, some of these candles. This one was about a candle premium around $200,000. Again here on the 2nd, around $200,000. And then over here, we can see that candle premium was over $1 million. And then if we do scroll down, these days are June 30th and July 2nd. So if I scroll down June 30th, we saw prior to June 30th, the open interest was 40. Or I guess I should say prior to June 30th, before the market opened, the open interest was 60 for that contract, with a volume of 4,864 contracts traded that day, leading to an increase of 4,777 contracts being opened, then leading to 5,000 over here with a volume of almost 6,000, leading to an increase in 5,600, getting that open interest up to over 10,000. But then we did see, a lot of volume on that day, which led to a decrease by about 4,000 contracts, bringing it down to 6,622, which is around where, it expired at. So a lot of those seem like they may have been exercised or just held to expiration. As you see, the premium here was going up. So, even holding those to expiration, you'd be, making a good amount of money on them, closing in the money. So very nice there. Hopefully that's helpful, my interpretation of that. The other one on the list is going to be the $27.50 strike. And we can see that the open interest on Friday was 5,567. I'm actually going to flip back to the $25.50 one just because I wasn't really interpreting that too well. But yeah, open interest 2,211 with a volume of only 85 for that 2550 call that has been expired. But yeah, getting back over, sorry about that, to the $27.50 call that is expired. Open interest on Friday was 5,567 with a volume of 106. So, a lot of those, again, closing in the money. We closed, where does it say the stock price? 28.80, I guess, in the after hours. So, yeah, I mean, this closed in the money. If we look back the past 14 days, I'm sure we'll see some bigger candles. So we saw here, this was on July 3rd. I feel like both of these candles were on July 3rd. Maybe I could just go back 7 days for this. Yeah, so we can see that a little bit better. And so this was a candle premium here of around $300,000. Getting excited. And this one over here, candle premium around $700,000. And I might have done a post about this, or so. I probably did. I think I did posts about all of these on X. So make sure you follow me there, dgen_Ann. It's up there in the top in the banner. But yeah, daily premium was over $1 million. And so that was July 3rd. So if we scroll down in the table, we can see that open interest starting out on the 3rd was 166 contracts, but then we saw a volume of over 18,000 contracts traded that day, which led to an increase by about 7,000 contracts, followed by the next day, a decrease of about 1,000, but going from, 166 and then with these contracts expiring, over 5,000 in the money. I think that's a really good sign. That does make me think that we could be seeing a gamma ramp or gamma squeeze going on. So even if the chart looks like it might be pulling back a little bit, I think it could just be, a healthy correction, a little bit of a bull flag maybe. If it does come down to 27 though, and max pain increases, what did I say max pain is for this coming week? 25. So if that does move up to 27 and price comes down to 27, that's, maybe going to kill the gamma ramp. But so far, this stuff looks pretty good. And then the next contract, man, a lot of them are expired. So I'm just trying to understand this stuff to think, do I feel like Unity is going to keep going up or is it going to be pulling back? And so this other contract is the $28.50 call that expired a couple days ago. And it looks like the open interest at the start of the day was 2,362. Volume was only 365. So a lot of those contracts, basically 2,000, closed in the money. They expired in the money. And let's just look back over the past 14 days, but man, I could probably just do that to 7. And we can see these bigger spikes. This was on the 3rd, and this was on the 7th. So yeah, this was on Thursday, the 3rd, before the holiday weekend, and that candle premium is around $650,000. And then on the 7th, once we came back from the long holiday weekend, candle premium over $1 million. So we'll have to see, were those buying or selling? Was the open interest increasing or decreasing? And so we can see that by looking at the open interest at the start of the day. For July 3rd, we can see that the open interest was only 82, but then it did see a volume that day of nearly 13,000 contracts, which led to a nearly 13,000 contract increase. Open interest going to just shy of 13,000. But on the 7th, we saw a volume of over 13,000, which led to a decrease in the open interest back down to around 2,000, which is where it ended at. So, even if you just look at this, like based on the average fills, which the average fill would approximately be the fill because they were just such big orders for those days. But we could see that, like for this, let's see, how do I want to think about this? So for over here, the big increase day, we saw the average fill of 51 cents. And then the next day on the 7th, when it looks like there was some selling that resulted from it that followed that, the average fill was 91 cents. So that's a pretty good swing right there. So, and still, 28.50, they expired in the money. They expired not worthless. They expired worth it. So yeah, I think that's really good. And, somebody made some money on it as well as premium, went up. So I think that's great. And let's just see, going back over to the next one on the list, more for July 11th. I'm sorry about that if you're not interested in it, but I am. And this is the $29 call. So this one did not expire in the money. This expired worthless by 7 cents. Pretty crappy, $28.93. But it is what it is. They're going to be worthless. And so there was, over 9,000 contracts open at the start of the day. Only 578 contracts traded during the day. So about 8,500 likely closed. Worthless. So that sucks. So this is maybe, where we're going to be looking at, not so good. And let's just see, going back 14 days, I could probably just do 7 for these higher strike ones just because they were done purchased, or, there was bigger candles more recently. But we can see here on July 3rd, candle premium of 650,000. And then on July 8th, so a couple days between them, candle premium was just shy of $2 million. And so actually very interesting here, like candle volume is 15,000. Over here, candle volume's around 15,000. So, I mean, this could have just been, a really nice swing trade, buying these at an average fill of 43 cents. And then if they were to have sold them, let's say over here, that average fill was 127. So that's almost a 2x right there, so just over the course of a few trading days, I should say, with that long weekend in the middle. And so, yeah, July 3rd and July 8th. So let's just scroll down to look there. So July 3rd started the day with an open interest of 38. And then the volume was over 15,000, which led to an increase in contracts by 15,000. And then on the 8th, there was a, and actually, this is pretty neat. I'm going to do a little bit of math here just to kind of, exercise the brain. But so let's see, over here, we got like 15,000. Let's just go with the number here. That's like the increase. So from that, just going to pull up the calculator. So 15,000. 345, so that's the increase in number of contracts there. Multiply that by the average fill from the day before. So that's 42 cents, and I'm going to do just 42 because it's 42 times 100 shares per contract is the value of them. And so that represents around $650,000, so that does make sense based on what we're seeing. And so this trader, let's assume it's one person, they risked $650,000 approximately. But then over here, when we saw the decrease by about 6,517, let's see. Let's just do some simple math here. So I got the number up there, which is like what the amount of money that was risked. And so from that, let's subtract 6,517, so the number where the cursor is, it's the number of contracts that were sold. And then I'm going to multiply that by the average fill, which was 104. And actually, times 100. There we go. And so I think that got kind of screwed up because I should have done some parentheses or something. So let's take a step back. And so what was the number over here? So that's, I'll just say 650,000 because it was that times that average fill was 42. So let's just say 650,000. Okay, so let's just round it. They're risking 650,000. Okay, and then so over here, when they sold, that's, 6,517. And then I'm going to multiply that by 104, multiplied by 100 per 100 shares. So just 104 there. And so that represents over $650,000. So even though these contracts expired worthless, this trader still made some money. It's like over 20,000 bucks there, 30,000 bucks. So yeah, I mean, I don't think that this is that bad. Congrats to that trader. If it was one person, they made a great move. And they still held some to put some pressure on getting it to above 29, or at least to for market makers to kind of want to keep the price below 29. So they were market makers were putting downward pressure because these calls were putting upward pressure to close the week in the money above 29, because then that person would then get a lot of money for closing and could have maybe exercised some of the calls. But I think they probably would have just done it for the premium. And so, yeah, let's just go back over to the 1 day. I'm going to go to the other one on the list, which is a $30 call. Also expired, on Friday, out of the money, unfortunately. And so the open interest for Friday was around 7,378. Volume was over 2,700. So more people, I imagine, getting out of this because it seemed like it was, going to expire worthless. And then if we just go back the past 7 days, see if we see some big candles. Maybe we see something that stands out even more. Nope. So yeah, just going back the past 7 days, and we can see these. This is not as clean though as the other ones, but we can see $500,000. This candle premium over here. Again, $500,000. So, even if it's just trading for that premium had gone up. So that was a nice trade. And we can see from these days, this was July 7th, over here, July 8th. And so we can see the open interest at the start of the day on July 7th was, over 2,500. And then on the 7th, saw an increase in open interest, an increase in volume of 12,857, which led to an increase in open interest by almost 8,000, putting the open interest at 10,000. And then there was this sell here. So maybe we can do like the same kind of math. So over here, when we had the 7,841 contracts, so I'm just going to type that into here, 7,841 times the average fill from the previous day when those orders were placed. It's going to be 53. So they're risking $415,000. If it's all the same trader, which it's probably not. Most likely not. And it's definitely not. But maybe a majority of it is. But anyway, so 415,000. And then so on this day, so let's just say 420. Let's just round it up to 420. $420,000. Okay, so over here, the number of contracts that were sold was 2,538. And if we multiply that by the average fill from the previous day when that volume took place, that's going to be 65. And so I can multiply that by 65 cents times 100 is 65. And so that represents only around 165. But we can actually see, I think that this is more than likely suggesting that they had lost money based on how I'm doing it. But if we actually look at the premium or the, let's see, the candle here. So this is $500,000 and the average fill was 58. So that's like, let's see, 8,000. I'm just going to bring up the calculator and I should be able to keep that there. So let's say those were all bought. That's 8,739 contracts times the, let's see, the average fill, which is 58 cents times 100, 58. And so that's a risk of like $500,000. And then if we go over here to this other candle, this might give a more representative because that average fill listed for this candle is 78 cents, whereas the average fill for the 8th was 65 cents. So what we can do is, let's see, the candle volume. So we want it to be above 500,000, which it's not going to be. Actually, it is. It says the candle premium right there. So, okay, yeah, that's very cool. This is actually a better way to think about it. So I had done the math there that's on the calculator that from that previous candle, it looks like over 8,000 contracts were purchased for about, $500,000. And then over 7,000 were sold, but less than 8,000. less than what they had initially bought, and they were sold for over $500,000. So they made money on this. So while the contracts might have expired worthless, the trader may very well have made some money. So I think that's pretty cool. Nice to kind of explore that and do that side by side comparison, and just utilize the math that's on the screen there, because yeah, like this candle 507, this one 561. So it's like, yeah, it's definitely more. So if it was the same trader, they'd made money even though the contract expired worthless. It's just going to flip back to 1 day and then go to the $31 strike that also expired worthless, unfortunately. And so the volume on Friday was over 8,000. Or sorry, the open interest was over 8,000. The volume was over 1,000. So a lot of these expired worthless. And if we do look back over the past 7 days, we can see these kind of big spikes here. So this candle on, let's see, the 8th was almost 12,000 contracts, candle premium $740,000. And then if we look over here, it's, I mean, to be honest, just looking at the premium coming down, unless they had sold up here, which that was on the 8th, no, the open interest increased. Wait, on the 8th. So the day after, open interest went up. So, yeah, I mean, it could have been like selling covered calls. I'm not really sure. I'm not going to think about that too hard. But yeah, I mean, if we look at the whole history here, 90 days, it's just those, 60 days, 45 days, 30 days. Yep. I mean, it's just those right there. And it did not continue with the momentum up. So that's unfortunate. But yeah, I'm just going to come back to this. The next contract is the $30 call that expires in January. So this one, I think, is, maybe one, it's not expired. So maybe it's a better one to trade. This is not the contract that I hold, which I will go over in a minute, like I said. But yeah, let's see what's been going on. Maybe I really just want to focus on the table down here. Yeah, we can just see how has open interest been changing. It's like 85,000. Look, I mean, yeah, when was it? So it's been 5,000, around 6,000 for a while. When did it start to really uptick? So on May 16th, went from about almost 7,000 to around 16,000. Dude, over here, 58,000. Man, these end of May, 62, 83. Where are we at now? 84,000 open interest. So that's looking pretty good. These are still out of the money, $30 strike. I mean, it looks like there has been some selling. So maybe that's suggesting, I mean, it does seem like, looking at the chart, it does seem like it could be pulling back some. So I think that makes sense. Yeah, so I'm not really gonna, I mean, maybe 90. Yeah. So yeah, I mean, we saw all these buys here. It looks like buys. And, so this is probably just gonna be a healthy pullback in that premium before it goes up more. That's what I'd expect. Otherwise they would have sold I mean, they trimmed, 2,000, 3,000. That's not a lot compared to the 84,000 that are still open. So that makes me think that price is going to be going higher. Maybe it takes a little while. Maybe it cools off a little bit before it does that. So, I mean, that's useful. That's makes me feel glad that I was trimming some on my calls. Yeah. And so the contract that I hold, which I'm not an expert, I have no idea. I don't think this is going to close in the money. I think it's going to expire worthless. But they're a little bit cheaper, like the ones that I was just talking about, the $30 strikes for January. The average fill on Friday was $5.63, which translates to $563 per contract. That's a lot of money. The one that I'm looking at, the $65 strike, $77 per contract. 77 cents times 100 shares per contract, $77. So, yeah, I like this one. We actually see the open interest has been going up. So that's kind of encouraging. And maybe, if I scroll down, we see open interest of like almost 34,000. So that's a good amount. When did this really start to go up? This is open interest here. I mean, there have been 20,000 for a while. It's like, yeah, I got to scroll back. November, October. Oh, okay, so over here. Yeah, October is when it was like going up. So, yeah, that's pretty crazy. But yeah, I mean, we do see open interest go up the past few days, so I think that's good. It could be like selling covered calls, though. That's another thing. Look over the past 7 days here. What was this? On July 8th, yeah, that looks like a buy. Because, I mean, it could be selling covered calls, so we'll have to look at that in the data over here. It might be helpful for that. But yeah, on the 8th, open interest of 30,000, and then it increased by about 2.5 thousand. And so that would be that. And so that was from, let's see, the 8th. So I think I can go back just 3 days looking at this over here. And so this was the 9th. So that was at the end of the day on the 8th. So I actually have to go back 7 days. And so 7 days on the 8th, we saw, net call premium go up. And we also saw volume going up. Maybe I want to expand that so we can see it a little bit better. Go back to the 7 days. Yeah, so on the 8th, open interest, or sorry, not open interest, net call premium in green going up. And volume going up corresponding with that. So that suggests that contracts were bought to open. So that's bullish. And then also net put premium in red was coming down. Also volume, though, is positive. So that suggests that, actually, let me think about this. Net call premium, net put premium, both around the same, but net put premium was negative 1.6 million, whereas net call premium was positive 1.6 million. So that makes me think that, that this is bullish still, like that there could be a continuation. So I think that's good, although there was an insider that sold apparently on the 9th, and yeah, maybe that's not such a good thing, but I mean, it is what it is. And yeah, so I mean, for me with this contract, let's see, what did I do? What have I been doing? Like I said, I've been trimming the past few days. My average for this is like 49 cents. And so I trimmed earlier in the week. Let's see, had to have been on Monday, I believe. I think I trimmed one at 60 cents. And then on the 8th, I trimmed another one at 98 cents. That's 2x for me. And the day after, I had a limit order to sell some at 125, and the high was 110, so that didn't get filled. I should have, just sold another at 1, whatever, sold a little bit more there because it's pulled back, and then I could be like buying on these dips. And then on Friday, because I had limit orders to sell on Thursday, another contract or two at 90 cents didn't get filled. So then on Friday, it's like, okay, well, I'll place some, not leave the ones at 90 cents, but also sell some at 80 cents. So I did, I made a little bit of money on that, but I am still holding some contracts, which maybe is a bad idea. Maybe I should trim out so I can then buy back if it does go back to like 50 cents. If we are going to be seeing a pullback, which I mean, like, if we're looking at this, let's just take a step back in this chart. Let's just go back 45 days. I mean, yeah, big move up and then a pullback. The lows over here for that premium, 30 cents. So I don't think it'd get down to 30 cents, but I mean, maybe it could because we're getting closer to expiration. So yeah, I mean, 50 cents, if that's for me, it's like where the cursor is. I could see it putting in a higher low at that. So yeah, I mean, then it's like maybe I want to assess if it does come down. If it goes below my average, then maybe I want to trim some at break even so I can buy back lower. I don't really know. I need to just kind of evaluate that for myself. But yeah. And then some other contracts. These are a couple puts. I've done some posts about these, so I don't necessarily want to dive too much into them. This is, $30 put that expires in January. And I believe what happened with this, it looks like it was sold here. And so this was from the 8th, 3,000 contracts for 1.86 million, 869 million. So maybe that's a good sign. Got the 69 in there. That was on the 8th. So let's scroll down, look at the data here. And on the 8th, we saw that volume of about 3,000, which led to an increase. But like looking at this chart, the premium going back 45 days, let's say, why would you want to sell down here when premium was much higher before? And so it makes sense that, for this order, both of these orders, this is on the 10th, I guess more recent. This looks like it was sold. So the 11th, and there was no volume, nothing traded on Friday. But yeah, so these would have been, bought, maybe cash secured puts for about $2 million. And so for that premium, it's like the average fill, this is $30 put. So yeah, I'm not really sure. Maybe I'm not going to dive too much into the weeds with this. But this is 3,000, 3,000. Yeah, so maybe I want to just zoom in on those 7 days. We can see here, so this one, candle premium, I believe selling cash secured puts. So what does that mean? Okay, so selling cash secured puts. So looking at that data that I've got there in that little box, we can see that the number of contracts, the volume, is 3,000. And the candle premium, it's right there, 1869. And so we should be able to get that number by multiplying that by the average fill, the 3,000, by the average fill. So that's going to be 623. So $6.23 times 100 shares per contract. And that's going to be 1869. Those numbers match up. That makes sense. And so that's the amount of premium that would be collected if someone was selling these cash secured puts. They would collect $1.8 million. But how do they secure those puts? The way that they do that, and so I'm just going to 1869, I can remember that. So this is 3,000 contracts, and for $30, $30 would be the strike. So multiply this by $30, and each contract representing 100 shares, going to multiply that by 100. And so that's $9 million. So, and then if it does close on the expiration date below $30, they would get assigned and they would have to buy the 3,000 contracts for $9 million. But that is with, the discount of 1869,000. And so they would have to put on the table about $7 million based on that difference. And if Unity Software closes below 30, they just buy 3,000 shares. There's 3,000 contracts worth, so that's 3,000 times 100 is 300,000 shares. at $30 a share. But if it closes out of the money, so above $30 on January 16th, then they would not have to buy the shares at $30, and they just get back the cash that they had used to secure those puts, which would be the $9 million. Or really, I mean, based on the premium that they had collected, they get back that $7 million. So in doing that, they would have made, they would have collected that premium, $18.69. So that'd be a really good trade. But if they had to buy the shares, they're bullish. So they'd be all right with that. So that's kind of, my thought process with that. Hopefully that's helpful. And then the other one is the $30 put that expires in June. So just about a year from now. And we did see this big candle here. That's $715,000. But if we go back over 30 days, yep, that's all that we see. So we could just 3 days, we can just go 2 days. So we can look at that. And that looks like, we can do probably some more math with this. Open interest was 12, and now it's over 1,000. This candle premium was right around 985. And so, yeah, we can do the math on this one as well. I mean, it's helpful for me, so I'm just going to do it for me, if that's all right with you. So yeah, I'm just going to hover over that, come over to this calculator. Man. I want that to, maybe I got to just be over here so it stays. Oh man, what's going on with this? Okay, so for this, I'm in the calculator so I can type. That's good. And so this is for the $30 strike again. So that'd be 9 million. Oh, actually, no, it depends on the number of contracts, which is 985. So we'll just do the math that's here on the in the box there. So the candle volume 985, and then I'm going to multiply that by the average fill, which is 715 times 100 is 715. And that then represents that, let's see, I guess the numbers are a little bit off. It's an average fill, so, but around $700, $4,000. Okay, so they've collected $700,000, but what are they risking? So I'm going to clear that again. And so it's 985 times $30 is the strike times 100 shares per contract. So they would be putting down about $3 million and then collecting that premium of around 704,284. And so they would need to have about $2.25 million to cash secure these puts. And then if they expire worthless, they get their money back and they've made $700,000. If they expire in the money, then they would get assigned and they would have to buy those shares. So, yeah, very, very interesting. So, yep, making $700,000 there potentially. And yeah, so those are like all the contracts that I kind of wanted to go over. Maybe I'll look at the flow real quick here. And, but yeah, I just want to look at one day, what happened on Friday. There were some drops here. Suggests this is a net put, drops in net call and put premium. Looks like there was some selling across the board, whether it's calls and puts. We see net call premium coming down by 620,000, net put premium coming down by 700,000. So yeah, I kind of feel like the move is not necessarily over. But as far as premium goes, I think what might be happening, just coming back to this chart, is that we could be seeing, where's the doodle tool? We could be seeing this come down, come back to that red line, and then go higher. And what did I have? And I'm actually curious, can I? No, I was thinking, can I? Because that arrow looks crappy. But yeah, what's that red line correspond with? $30.88. That was the high over here from February 21st. Also, it does look like I have this Fibonacci extension, kind of big picture here. That's suggesting price could be getting up to around 32.25. So yeah, I mean, I think that we might be seeing like a little bit of a healthy pullback. So to be honest, might be good to trim a little bit more of those calls just to manage risk. And then, see this start to move up. So maybe a time frame. What's like, let's say if it were to pull back to this intersection here, that would be around August 12th. If it were to pull down over here to there where the doodle is, that would be around July 23rd. So I'd say we've got about 2 to 4 weeks of this potentially bottoming. And then maybe it really starts to move a lot higher. And, bigger picture, I do have this doodle that I've talked about this in prior videos, but yeah, inverse head and shoulders pattern here that, hasn't even gotten to this right armpit. But I do think that would be very nice, even if we saw a pullback down to around where we're at now. But that would be a move up to around 45 or 43.65 is the purple line there. Then a pullback to around 30. And then, I could see this going to around $75 a share by the end of 2026. But I could see it going to around 45 or 43 by the end of 2025. So yeah, I'm going to have to say that, long term, I'm bullish on Unity as far as those contracts go that I think will be expiring worthless, which are the $65 strike calls. These are the ones that I hold risky. Even though, seeing open interest increasing a little bit, I think it might be a good idea to take a little bit of risk off the table. So if it does pull back like this, one could take advantage. And if it doesn't do that and it continues up, one still has contracts to trim. So I think it's good to have a strategy for a pullback and good to have a strategy for a continuation. So that is personally how I am going to be positioning myself, but you do you. And as always, those are just my thoughts. If you found them helpful, make sure you like the video, share your thoughts in the comments down below, and make sure you subscribe to the channel for more videos like this. Thanks a lot for watching, and I hope you guys are having a great Sunday. Talk to you later.